Welcome to Go Simple Tax, where today I'm looking at 6 key things that everybody needs to know about pensions and self-assessment. Before we get into it today, don't forget to like the video and subscribe for more helpful tax content. Now let's get started with today's video. And the first point to clarify, because lots of people don't know this, is that when you eventually draw down on your pension income is taxable income. Now, don't let this put you off, because as it stands, saving through a pension is arguably the most efficient way to save money, in particular if you are saving specifically for retirement. But it is important to understand what tax is payable when you draw down your pension. When you first draw down on a pension, you are able to take up to 25% tax-free, but that is limited to £268,275 where you have a large pension pot. Income tax is then applied in the usual way to the remaining amount before you receive it. The way tax gets calculated is different depending on a number of factors. If you have a state pension from the government and a private pension, then it will usually be the private pension provider who will deduct the tax for both. And where you have multiple private pensions, one of the providers will be assigned to deduct tax on behalf of all. If you're only entitled to the state pension and your income is below the personal allowance, which is currently £12,570, then you won't actually need to pay any tax at all. If your total income exceeds the personal allowance, then you may receive a letter in the post known as a simple assessment or simple assessment tax bill telling you how much you need to pay and how. Where you draw a pension but you also continue to be employed, your employer will deduct tax due from your earnings via the PAYE system. Where you draw a pension but you also continue to be self-employed, then you're going to need to complete and submit a self-assessment tax return to HMRC. This allows you to report all taxable income, including any income from state or private pensions, and will identify how much tax you need to pay. The second thing that everybody should be aware of is when you can access your pension. And again, this will depend on the type of pension that you have. The state pension, for example, can currently be accessed from the age of 66, although the state pension age has actually been steadily rising in recent years to account for increased life expectancy and an aging population, and it is set to jump to 67 between 2026 and 2028, and then 68 between 2044 and 2046. Thankfully, workplace pensions and personal pensions can be accessed from the age of 55, although the specifics will be detailed in the individual policy, so 55 is more of a minimum age, but again, this is set to jump to 57 from 2028. Getting hold of your pension funds any earlier than this is pretty uncommon. Now, it's perfectly possible. In fact, you should be able to access a personal pension plan whenever you like, but a tax charge of up to 55% is usually enough to prevent people from doing this. There are, however, a couple of situations where early access may be permitted without the eye-watering charge. The first is where you have a protected retirement age. Typically, this only applies in careers where early retirement is common, such as professional sports. The second is where ill health prevents you from working or leaves you with less than a year to live. In either of these situations, you may be granted early access to your pension. The third point that everybody should know is that even once you start receiving a pension, whether it's a workplace pension or the state pension, this doesn't prevent you from working. Even where you want to continue working with the same employer you've been making your pension contributions through, drawing down on that pension wouldn't require you to end that employment. So you can continue working beyond the age specified by your pension provider. When it comes to your state pension, which remember can currently be drawn down from age 66, you'll be contacted as you approach state pension age to ask if you would like to start receiving your weekly payments or if you want to defer them to a later date. Now, you might be wondering why anybody would want to delay receiving their state pension, but where you do choose to do this, your weekly payments will actually increase when you eventually start drawing down. And whilst I'm on the subject of continuing to work after receiving your pension, it's also worth pointing out my fourth need to know, which is that in most cases you cannot be forced to retire. So if you want to continue working after 66, that will be your choice. The exception to this is where a job requires you to have a certain level of physical or mental well-being, or if the job has a maximum age limit determined by other legislation. Next up, the fifth must know. Let's look at what you'll actually receive from the state pension. The new state pension will be paid to anyone who has a minimum of 10 qualifying years on their national insurance record, but you'll actually need 35 qualifying years to earn yourself the full entitlement of £221.20 a week. If you have between 10 and 35 qualifying years, then you'll receive a proportionately reduced amount. If you're wondering what a qualifying year is, it's just one where you were working and made national insurance contributions, or where you've been getting national insurance credits, such as when you're on maternity leave, or where you've made voluntary national insurance contributions. The new state pension applies to men born after the 6th of April 1951 and women born after the 6th of April 1953. Anyone born before this would qualify for the basic state pension, which follows a different set of rules. Everyone eligible for the basic state pension has now reached state retirement age. And the final must know about pensions and self-assessment is how you obtain tax relief for contributions that you've made to a personal pension plan. Now remember, a personal pension plan is one that you would usually arrange yourself, so it's different to a workplace or the state pension. With a personal pension plan, you're usually making contributions from income that you've already suffered tax on at some point. One of the ways that the government incentivise you to save for retirement is to offer you tax relief on pension contributions. So there are a couple of ways that this can happen with contributions to a personal pension plan. The first is known as relief at source, which is where the pension provider will go to HMRC and claim back the basic rate of tax that you originally paid on that income. So if you paid £800 into your personal pension plan, then the provider should be able to go to HMRC and get a further £200, which is then added to your pension pot. This is actually what happens in the vast majority of cases, but there are some situations where you'll need to look at a second option, which is to claim the tax relief yourself. This might be because either you're a higher or additional rate taxpayer, which means that although the pension provider may have gone and claimed 20% tax back from HMRC and topped up your pension contributions, in actual fact, you suffered 40 or 45% tax on that income, so should be entitled to some additional tax relief. Or your pension scheme isn't set up for automatic tax relief. This is fairly rare, but it's worth checking with your provider to see if this applies. In either of these situations, you would need to complete a self-assessment tax return and detail the contributions you've made to a private pension plan throughout the tax year. The additional tax relief will then be applied by either reducing your overall tax liability or triggering a refund where there is no liability. Those were 6 things that you need to know about pensions and the self-assessment. I hope you found that useful. Thank you for watching. See you next time.